Hi, Chris Davies from ABC Advisory. I got Mike and Alan with me again this Friday for our discussion on investment topics. Veronica's with us too, and they'll join me after I go through a few points I want to make about where we're headed into the summer and where we are right now in terms of the market being maybe a little bit overbought here, which could be viewed as a positive measure, and also a moment here to take some take a perspective that this could be a bit of a time for consolidation in the next few weeks. So the first thing I want to talk about is the overbought state of the market. And there's a couple slides and a couple charts I want to bring up. First of all, we wrote a little blog about this. It's called This Rare Technical Signal. I'm not going to open that. You can go to that a little bit later and read that yourself, but it basically refers to the fact that the number of stocks, or the percentage of stocks above their 50-day moving average, is at an all-time record high. In other words, the market sold off so hard, the 50-day moving average went down, and these stocks then rebounded, and all the stocks in the market now are above their 50-day moving average, something around 95%. This says on the NYSE, the New York Stock Exchange, 91%, but in the S&P 500, I think it's around, I think it's 95% or something. So again, extremely overbought times, which could lead to a rather sharp but short-lived sell-off, or just a flattening, and then a large, generally 6 to 9 months from now, the market's up, and sometimes up quite substantially, another 20–30%. So we've highlighted that in the blog here. And we've talked about the long-term kind of positive momentum that this provides the underlying stock market. So I wanted to go back and say, well, what's going to happen maybe this summer? And we're going to talk about that a little bit. And this was a research note that came out, I think, in the end of beginning of May. Veronica and I covered this 2 weeks in a Russian language webinar. And we basically, I'm just going to take through 4 charts here that, everybody knows there's a sell in May and go away strategy, and we've written about that many times on our blog. It's basically part of our seasonal strategy, where you get defensive in the summer months because they don't provide the types of returns that you can get in the winter months, and that's generally true in times of and in all kind of years, from 1928 to the present. May to October is the weakest, whereas November to April is the strongest. However, if you look at the 6-month seasonal strategies, or 6-month seasonal returns, and the percentage of time up, but during only the 4th year of presidential cycle, you see that June through November and July through December are the strongest 6-month period, whereas January through June is the weakest 6-month period. So this is more what's happening this year. We've highlighted that, like I said, a couple of weeks ago in Russian, and I just wanted to bring everybody's attention to the fact that you notice kind of an anti-trend during the anti-trend policy during the fourth year of a presidential cycle like this year. So what do we do this summer? We see that generally, even in all year, every year, there's a summer kind of rally after this May sell-off, and then you go into kind of a problem in September. So June and July are not always negative months. In fact, they've historically done rather well. But during election years, these months are much stronger. These are actually, August is the strongest month going into the election year, followed by July. So now, when we showed this 2 weeks ago, we had this kind of mentality that, okay, but May could be really weak. Well, May wasn't weak this year. So I'm a little bit hesitant that we might be with a one month delay here, and then we might see some weakness in June, just because we're so overbought, and this would lead to at least to some alleviation in the pressure in the bullish pressure. So maybe we get a weaker June, and we then see some strength in July and August, and maybe even September. So if we get any kind of pullback in June, we would use that as a to get more into the market and be more bullish as the election season ramps up in the United States. So I just wanted to point that out, that the 3 months returns are the best, are not bad in June and July and August, and in presidential cycle that they're actually through June through August, they're the best. So we're headed into what could be and what should be a good summer rally. So, well, take that with a grain of salt, of course, but this is really historically a typical trend we've seen throughout history during times of the fourth year presidential cycle. So that was the Bank of America stuff. I think, Alan and Mike, I've shown that to you before, and Veronica and I have been through that, but I just wanted to let everybody know that that's kind of where we're at again. Another topic I wanted to bring up, besides this rare technical signal that we've seen, is the another blog that I wrote, and I should have posted a long time ago, but one of the things we see was coming out of the March lows, we saw in April a long process of people getting devoting their investment money to technology stocks. So we saw a big run up in things like Apple and Google and Amazon, and we highlighted that in Telegram several times. But now, as more stocks in the market follow through with a bullish positioning, we're seeing industrials and potentially transports, some of these really beaten up stocks, but with a large what we call value stocks take the front seat. And NASDAQ published a nice article on this recently that that basically shows how oversold value stocks really are, and comparatively for the last 20 years or 15 years. And you're at times we haven't seen this type of oversold market in value stocks, or relative to growth stocks, or underperformance by value stocks relative growth stocks, since the lows of 2008. So when we're looking for a increased bullishness later on in the summer, we might see this in sectors that typically have been underperforming. These wouldn't be the big tech stock sectors. This wouldn't be the software, the companies that have been leading this market that are now extremely overpriced, but this would be things maybe like airlines as they come back to work. Or, of course, there's some REITs, there's the restaurant stocks, but there's also industrial stocks like the defense stocks that are beaten up really and have great balance sheets. What we see going on with China, threatening with Hong Kong and with possibly Taiwan even, these defense stocks, defense company stocks like Northrop Grumman, Raytheon, Lockheed Martin, General Dynamics. There's some stocks in there that have, or companies in there that have great balance sheets and have just been beaten up with the market that really are still performing rather well. So we look for maybe a return of those stocks to leadership positions in the market, which will fuel the second part of this rally in the second part of, or the latter part of summer. I wanted to just go through the two other kind of news items that we're seeing, and Trump should come out, and I'm sure Alan and Mike will comment on this later, but we see Trump coming out with a news against social media and against China. So the flare up in the China-US relations, the trade war, is taking on a new kind of even military aspect, possibly. This has brought a lot of attention to, how does it affect US stocks? So I ran a little, some statistics, some analysis, and showed where the Chinese, any kind of increase in Chinese tensions would affect some certain stocks in the NASDAQ. And of course, there's some ADRs from China or companies of China that are listed in the NASDAQ and make up pretty good weight. So that could affect the leadership of the tech stocks and the tech indexes in the near future. We also just wanted to mention the social media kind of problems in the United States, where Trump has made some claims recently about Twitter specifically and Facebook. He signed an executive order. We covered that in Telegram a couple days ago, and we just wanted to make sure that people are aware now that these companies may come under additional pressure from the U.S. administration, and it might create. There was news out this morning that he was Trump was gonna ban Twitter, although he's the biggest proponent of Twitter. You would seem in the last 3-4 years. So it's kind of a stark difference to where we've been, and this could provide again additional downside for the Qs or the tech stocks if any action really is taken against Facebook and Twitter. So that's what I had to cover. That's what I've been looking at. That's what I've been doing this week, watching these types of things, posting some blogs here. Some of these blogs are not translated yet into Russian, but they will be. And I just wanted to kind of open up the mic for comments, questions to Alan and Mike and Veronica, if you guys wanted to show anything, or I know we had some other things we could talk about. We got a lot on our plate actually, so go ahead guys, what's up?
Chris, yeah, I'm interested in the overbought US market because it just seems, I mean, I'm a natural pessimist, I suppose, or a realist, and I just find it very difficult that all of those stocks are over their 50-day moving average, but maybe that's a reflection on how far they fell rather than how great they are all performing. I can't remember if it was on this Friday talk last week that we talked that there's something like the statistic is 40% of Americans earning under $40,000 per year got made redundant in the last 3 months. That's just a staggering statistic for me. I think
what Veronica mentioned the other day, I think it was a quarter of the workforce in the United States is now unemployed, and they get these $600 checks, right? In addition to the unemployment, and that ends in July. So, yeah.
But even that is not generally or necessarily a substitute for work, both financially and psychologically, I suppose. And I think that's maybe, you know, we might be in for a summer of discontent if what we're seeing in America. I know it's very topical right now with some of the unrest, social unrest, but surely part of that is obviously because of what's happened, the specific event, but it's also possibly because of pent-up frustration, you know, social dislocation, if you like, or financial dislocation because of what's going on with coronavirus. I find it it's just too rosy a picture in the stock market, and I think I'm going to probably steal Mike's thunder a little bit, and I mean, the detachment from Main Street to Wall Street is maybe never been greater. I mean, the Wall Street is all rosy and everything's going up, and Main Street is a disaster.
Right,
rental contracts closing down, etc.
Right, and I think that's a good topic, and we'll see how that plays out over the summer, because you know it's a good thing we have these every Friday so we can kind of reevaluate how things are going. Because I just got an email this morning from a Russian consultant with a whole blog he wants me to post about, you know, how overextended things are, how things are not priced right. And we talked last week, I think, about the pricing on some of these, you know, even Apple and some of these large companies and what their multiples are. In the blog I did cover. I didn't really want to open it up, but I will just show one thing. Like, you're going to see this company, you know, these SaaS, which is software as a service. So these are kind of recurring revenue. Basically, you pay every month. And then, you know, one of the companies is DocuSign here, where it's got a $23 billion market cap and a revenue base of less than $1 billion. So this is an enterprise value to sales of, you know, almost 21%, which even during the 2017 when the market was doing, you know, was just going straight up, it only had enterprise to value to sales of 7.5%. So all these companies are so extremely overvalued. This is why we see the potential for other companies taking the leadership. And I mentioned some of those, but we even highlighted them right in the blog. So those people that have access to ABC Pro can read about that and maybe take some positions, or we can talk about these positions with some of our clients, because we do see at least if we don't get a pullback, a leadership change. And I think that's the key. We might see just some kind of rotation rather than just an immediate sell-off in all assets like we had again back in March. So we got to be selective here a little bit. And I did want to I didn't bring this up earlier, but we talked about this last week too. Alan, we're at, I don't know if everybody can see this, but I can show this little graph here. This is the put call ratios we went over last time, and this is extremely low values. And the author again even highlights that the last two times this ratio was this low were January 2018 and January 2020, which both acted as basically major tops of the market. Now they didn't play off; there were sell-offs in the next month, usually in February. But you know, you had these things, and then a month later there was a quite rapid and large sell-off. So we would be very cautious if these things did roll over, and we would highlight those signals in the blog and on Telegram, and we would talk about this on the Friday. But until we see those signals, it's a little bit premature to say that the market's ready to roll over and you know, have a full-on collapse like we saw earlier. And even then, when these roll over, we could see that there's just a rotation into more value plays. So we're watching that, right? I mean, that's what everybody's got their eyes on.
Can I just pick up
I'm with you though, Alan. I mean, things do look. I'm kind of the ultra pessimist. Sometimes I catch myself for being too pessimistic. But if we stay with the technicals in the market, we'd have to stay long here, because Investors Business Daily also says that there's only one distribution day now, and we would have 4 more days of large sell-offs before on higher volume than before we would even say that the market's ready to kind of roll over. And I don't see, I mean, we've seen some, remember guys, the VIX is at 30. So when the VIX is at 30, you can have these big declines of 1.5%, 2% per day. And that's normal. It becomes the new normal, right? So the market's going to trade up 1.5% or down 1.5%. And that's pretty much normal. Whereas before, you know, the market would travel, you know, the market was just less volatile. There wasn't these big moves. So, you know, we have to be prepared for if the market's down 1.5% in one day, it might be up 2% the next day. We've seen a lot of that in the last 2 weeks. You know, the market just doesn't go up every day; it goes up and down with some volatility. But until these put call ratios roll over, we have to be bullish. I mean, we just have to be bullish. So that's where we stand. I think I covered everything I wanted to cover. Did you want to go through some any stocks or any kind of ETFs that we've been talking about? Like, I've got some notes here that both the US dollar and treasuries are now in bearish kind of technical positions, and gold and emerging markets are also facing some bearishness because of the strength of the stock market, but they're not strongly bearish yet. Developed foreign markets have strongly bullish posture, and we see mostly bullish posture in all sectors of the market except for utilities and consumer staples, because those are things that are, you know, kind of the safe havens when people are fearful. Germany, Japan, and Russia are the strongest major economies, whereas China is the only major economy with a strongly bearish posture. We discussed that last time, though Alan pointed out that there would be possibly some buying opportunities coming up in China. I think this clear up with Hong Kong and this Taiwan potential situation may put that off for a little while. And I think that's all I've got, really, guys. So unless you have some more comments, Mike, did you want to? What have you been watching? What have you been talking about with clients?
Well, somewhat nervousness about the amount of the breakouts recently, and interesting contrast in the US markets. What clients are talking about is kind of this canal of flowing money that is the markets, banging from side, the water that is the money is banging from side to side, where one side is tech and high growth, and the other side is value and traditional. And there's a correlation with the exit from coronavirus is when we're going to stay locked down, the money bangs to the side of growth and tech. And when we're looking a bit more like liberty is on the cards again, we're banging towards traditional towards things like restaurants and conventional engineering stocks. And this isn't happening in Europe. This isn't happening in European markets. So we talked about developed foreign markets, where a lot of clients are also allocated to. And there's a lot more conventional stability. And I get pressure from clients to allocate more towards America because of the psychology that I call fear. Well, that everybody calls fear of missing out, I think. And so these heading for the tops that in terms of, as a financial planner, makes me nervous rather than investor during the contrast, because this is injecting some degree of risk for the short term, and the risks losing sight of the goal base of the financial planning rather than the short term win that we might miss out on this huge gain. And
and there's always this fear, right? I mean,
we last week, it's like too dangerous sometimes.
Yeah.
I'm the optimist amongst us.
And I was going to try to highlight something here where we brought that up, that there is this fear of missing out, and there was some graphs actually showing this, but there's also, and we didn't talk about this last time, but there's all this. So a lot of people can't gamble in the United States. I mean, I don't know, I'm going to pull this out of a hat, but basically a lot of people can't gamble in the United States and in China. And so what they can do is open up brokerage accounts where there's no commissions and start gambling there. So basically that's there's been this huge spike in the number of accounts opened at retail brokers. And I'm trying to find oh yeah, here it is. Where can I browse? Yeah. So I don't know if it's in Russian, but you can see on Telegram here, we kind of showed this graph that the total number of E-Trade and TD Ameritrade DARTs, these are day trading active retail clients, right? Daily active retail clients, just spiked, right? As the markets went down. So we saw a lot more retail money coming into the market. And we've seen, and we've highlighted on Twitter, on Telegram also, the number of the type of trades that they're doing are these short-term, highly leveraged options trades. So you're seeing a lot of people buying calls on anything that is rebounding, and that's added a lot of this, like you say, the slosh in the market, where it's 1 week it's this, it's the next week it's this, it's moving around, and this creates this kind of feeling like, oh my God, I should also be involved in this somehow. So remember though that this is what the street calls stupid money. When they see this happening, they say, okay, this is stupid money, and we need to all be very careful of what happens when stupid money gets into the market, right? They don't know what they're doing. They're just tracking momentum, and we've seen momentum stocks therefore really increase in value to the point where it's become an overbought situation and unsustainable. And so we're looking, especially in things like biotech, biomed, and medical tech, and anything that has this software as a service. So basically anything with some kind of recurring revenue where people automatically pay a monthly fee, like Zoom, like DocuSign, like anything that helps the stay-at-home economy. And you've seen a lot of money pouring into these places, and continually, like online gaming in the United States is huge now. There's a lot of stuff where if you're at home and you're doing stuff, it's online gaming, mean betting, but there's also like what kids play, these Fortnite and all these other games. So you see ATVI or Activision and Entertainment Arts. These are companies that attracted a lot of attention from these retail clients. So yeah, we see this sloshing, we see this moving between these fast sectors. We try to cover that in Telegram, but I don't want to draw a lot of attention to that. I want to keep we all want to keep the portfolios kind of diversified and safe, like we talked about last time, Mike. So yeah.
I think Chris, just to finish off, I don't know if you want to bring up the chart of the FTSE in the UK, because that's I think that illustrates one of the European markets, if we're still a European market, Mike, that basically is a very negative. I mean, it's not negative, but it hasn't rebounded anywhere like any of the main American markets have, certainly not the NASDAQ.
Right.
I mean, it sucks. I mean, especially I looked at the FTSE 250, which I think is a really good time. If you think about the move to value, and you think Britain is undervalued, then that's a kind of double opportunity, I suppose. The problem is that Britain is putting itself into a position more and more where it's going towards a no-deal Brexit, which is not going to be good. And that's going to harm the currency. That's going to harm the economy. What's interesting about the FTSE, though, is the FTSE 250 is a lot of those companies don't trade outside the UK. It's very much domestic market, very similar to the TNA, IWM, which is the Russell 2000 in the US, or the TNA, which is the leverage version of it. So very much domestic focused. It doesn't really care about WTO rules or anything like that. Of course, it is affected by it, but it's not as affected by it as BP or Coca-Cola or other big multinational stocks. I don't know if you can bring it up though. What is?
Yeah, I'm trying to find the symbols for some of this stuff. So VC,
okay.
MVC, I think it is MVC.
No, I'm not sure.
This is the. Let's see what this is. This is the. No,
the last time I looked at it at the FTSE, it was yielding about 4%. Mike, you might have a better handle on this than I have. More recent, but I mean the FTSE at anything around 4% yield is generally good value, and probably is a good time to buy for the medium term at least. I don't know about the FTSE 250, but the FTSE 100 certainly is yielding around 4%. So it's a good time to buy and hold if you want to allocate some money to pounds. Certainly if you've got dollars now, it's probably a good time to get some money into pounds before the dollar starts to weaken again.
I'm trying to find.
Yeah, I think the yield might even be higher than that. But
I think so. I think that was before the virus.
Yeah. The thing with the value investing is always, where are we going to find the catalyst for that actually makes the value valuable? The perceived, other than living on dividends and getting paid to wait for 5 years, which is
people have been waiting for a lot longer than 5 years.
Yeah.
There's a FTSE. Well, that's Vanguard's index of it. Yeah, actually, this is like coming up into this place of no man's land here. This is a huge gap. So, well, Mike, I was looking at companies like Raytheon, right? So this is like, this company hasn't done well since it fell off a cliff. It was at 100 and now it's at, somewhere around 65. But this is actually a new company. But Lockheed Martin, these are big defense contractors, and you wonder here if what's going on with the political environment in Asia and China, in America and China, there could be huge value in these companies.
Have a look at XAR. The ETF XAR would be a good indicator on
defense and aerospace.
Yeah. Again, this broke out, which was a clear breakout. So if we get a retest of somewhere down here at this level of 82, I would expect this to, this fallout here is just because people think that the budgets in the U.S. are going to be cut because we have to support now the unemployed and we don't have time to build ships and rockets and stuff like this. But this, these companies in the U.S. actually do have a large workforce, and Boeing and stuff like that, even not necessarily the defense industry, but Southern California has a huge, rocket design industry and Air Force industry, and I mean, there's all kinds of stuff that hires a lot of people. So if money goes back and
we now have $3 trillion more dollars to spend on it.
Yeah, I have a hard time thinking that this is these budgets are going to be cut so drastically to basically cut these companies down and half size these companies. So people look at the dividend payments on some of these things. I'm going to try to bring that up.
I have clients who agree with you. We've been allocating in that direction just this week.
Yeah, so this doesn't have a, but then there's companies like, typical stuff like Coca-Cola, right? Coca-Cola has a dividend now of 3.5%. And do you think people stop buying Coca-Cola just because they don't have a job? I mean, to me, that's all they're going to do is buy more Coca-Cola because they have more time to drink it. You know, these kind of things where these companies just got decimated, right? And is there if all your tech and all your stuff is overbought, where do you start allocating money? You start allocating money to Coca-Cola, Pepsi. You might allocate it to
maybe the argument with Coca-Cola and Pepsi is that the hotel and retail entertainment,
retail chains and stuff might be gone, but if they do
hotels
open
and all that kind of stuff, is they're not buying, and they were the ones that are buying. I mean, Britain. I think there was a Britain complained that there's a milk lake that basically has to be used up because the normally hotels and whatever is buying so much milk, and no one's buying it.
Yeah, and as we see the kind of economics of putting people back to work, I think that those and opening up some restaurants and stuff. I mean, it might not get back immediately, but that's the kind of optimism that these places aren't out of business for good. Another one we look at is, you know, Altria, which is Philip Morris basically, and this thing pays almost a 9% yield on this for cigarettes and e-cigarettes. So, you know, it was devastated, and it's been devastated by government regulations towards banning e-cigarettes. But with a 9%, almost 9% yield, this is going to attract the attention of value investors. So there are a lot of companies that have been beaten up, and there are, you know, people are going to, I mean, we saw last week, the last 2 weeks, kind of this focus on industrials even, you know, where are these industrials? And we had a huge breakout in the industrial sector. And, you know, again, a huge breakout here in the industrial sector, and whether this can keep going up or not is yet to be seen. But I don't think these rallies, if the rally continues into the summer, I think this is where, you know, you're likely to see this continuation, rather than things like Amazon and places that have really rallied up earlier this year on this stay-home economy stuff, and have kind of taken a hard now and are probably overbought. So we'll check in next week and look at some of this stuff, but
Cool.
I think that's enough for today. Yeah, I think we've covered a lot of ground. So I want to thank everybody for attending. Yeah, Mike, Alan, thank you. Veronica.